In Lemonade's Q3 letter, they said adjusted EBITDA profitability is expected to follow in 2026, a few quarters after our cash flow turns positive. In this video, I want to look at, is this realistic? Is it possible that Lemonade could actually be adjusted EBITDA profitable in 2026? And what kind of assumptions do we have to make to get us there? So we're going to dive into my Lemonade model and look at what I have for the next few years out to 2026 and then even into 2027, because from Investor Day we had some glimpse into the future up to 2027, kind of when Lemonade management was expecting until then. So a big thing that's happening with Lemonade and insurance companies in the US in general right now is that inflation is coming down, and in core inflation in the US, but insurance prices that have to be approved by regulators before they can be sold to customers, those are slowly being approved, those new prices. So there's sort of two positive actions. Inflation is coming down, which means, of course, that affects insurers because then the cost to, say, replace someone's home or replace a car or whatever asset is insured should be cheaper in general. And then also the rate increases sort of across the board as insurers is going up. So two positive stories here, and the timing of those is really important as we try and look out over the next number of quarters for Lemonade. And the value of these rate increases for Lemonade is really, really powerful because it automatically, if you're adding price to what the customer is paying for their policy, you're immediately adding premium per customer, adding to just more premium per customer for free, essentially, for the same cost, whatever your payout cost would be for that, a group of customers if they had a claim. But you're also then improving the loss ratio. So those extra dollars are essentially going right down to the bottom line through the loss ratio improvement, through the premium per customer improvement. So trying to figure out what those improvements could look like and accurately trying to understand that is really, really important, which is partly why I asked Tim Bixby, Lemonade's CFO, on Twitter about a question from the Q3, from a paragraph of the Q3 letter. He said, in the letter, it said, we're not impervious to these forces. I'm talking about inflation here. Of course, our response to them has been a massive increase in our pace and scope of rate filings. As of Q3, we have earned about $45 million in premium from our new rates, with a further $120 million online, but yet to earn in. Further rates await regulatory approval, so that during 2024, we expect to earn an additional $100 million or more from increased rates. And I asked Tim, I said, okay, what are you guys really talking about? This $120 million online? Like, does online mean that that's already sold to new customers as IFP? Or does that mean that it's just a product that is available, but none of those $120 million are yet sold to any customers, but once they start renewing or buying their new policies, they will? And then this additional $100 million, that's still coming later, and I'm sure none of that for sure would be in the IFP. Is that in-force premium right now? Is that correct? And Tim gave me a couple answers. He said, online means that we've had the rate approved, and yet to earn in refers to the process whereby upon renewal, the new rate kicks in. So it basically hits the IFP. Additional premium begins to register on gross earned premium. I think it only kicks into gross earned premium once say you buy a 1-year policy. Once that 1-year policy it ends, then it becomes gross earned premium. That earned premium is earned. But he said, put differently, our letter notes we expect over $100 million of gross earned premium next year to come from rates that have been approved but haven't had time to kick in for many customers. Once they do, the new premiums will register immediately on IFP and will earn in over time on gross earned premium. So my understanding of his explanation is that $120 million is available for is priced right, that once customers renew their policy, they'll be renewing in at this much and gaining this $120 million in additional premium as as customers renew their policies. But that's not into the in-force premium yet. As well, an additional, 2024 range, an additional 100 million, even says greater than 100 million, will also come in from further rate increases that are kicking in, and customers will be renewing at these higher rates. So my quick math and analysis or thought on this is that, hey, they have about 220 million in premiums coming just from rate increases. And currently, from Q3 when this was announced, this is on a book of business of about 718 million. So it means about 220 million of 718 million is about a 30% increase in premiums. And this seems reasonable because there's places like in California, they recently saw a 50% rate hike on auto approved. Of course, there'd be other rate hikes all across other states, other product lines. So maybe an average sort of premium increase of 30% across the board could make sense, certainly seems reasonable. And I'm going to assume maybe this takes, if we're talking about when it's going to hit in-force premium, for this analysis, I'm going to assume this 220 million takes until Q1 of 2025 to really come into effect. So even 1 quarter later than they're saying in 2024. So I'm going to say 220 million divided by counting Q4 of this year, 4 quarters next year, and then the first quarter of 2025 by 6 quarters. I'm going to look at about 37 million per quarter in IFP will be added in simply from these rate increases cycles taking effect. I'm going to assume that in my model that, or kind of think about that could sort of linearly grow across each model, linearly grow here across the amount of premium over the next 6 quarters time. So if we're looking at my model, and if we start with Q4, so this upcoming quarter, the quarter that actually just ended, but the results will be upcoming for, and if you look at premium or IFP, we had 718, and say 37 million gets added to 718, that gets you to 755 million in premium. So you should get to about 755 million in premium just by rate increase sort of cycles occurring and happening. Then another way to look at that, though, to see if this number is accurate for this upcoming quarter, because 755 is a very aggressive number, so we want to make sure this is making some reasonable sense. If you look at the guidance that was given at the end of Q3, they said in-force premium of 726 to 729. This is versus Q2 guidance that said at the end of the year they'd have 710 to 715. So they have a tendency, Lemonade management, to be conservative in their guidance and then beat their guidance. So their guidance was 726, 729. I'm saying just their rate increases alone, you'd think could get them closer to 755, a very significant beat on what they guided for. But then the other way to look at that, if you just break it down to the premium, the amount of customers you might expect them to grow into and the premium per customer, I'm expecting about a net customer change or customer growth of about 36,500 customers in the quarter, significantly less than Q3. Q3 tends to be their biggest customer growth quarter. Q4, it tends to be a little bit less because Christmas season. Q3 is more because a lot of renters, people buying new policies for renters are moving for school, that kind of thing. Q4 it tends to be less because they don't like to spend as many ad dollars because they're then competing with people that are also spending ad dollars for Christmas season. So it's a more competitive advertising market. But there was a post here I did when Lemonade reached 2 million customer mark. I did a little bit of analysis that said, hey, they're gaining about 417 customers per day so far in Q4 in the first 38 days of the quarter. And then I just said the current premium per customer, the rate, they might be in 730 million, 332 million IFP at the end of the year. But I had a little bit of feedback from Lemonade management that said, hey, actually they reached 2 million customers a few days before this, so they're actually doing better than this 417 customers per day rate in the Q4 quarter. But then there's also Christmas season coming where they're going to actually grow less significantly than the start of the quarter. So my sort of quick math on this, I said, hey, maybe if they're 3 days sooner than that announcement, they're 450 customers a day, and then say they grow at a slower rate. I said for one third of the quarter for Christmas, they instead of 450 customers a day, they grow at 300 customers a day. So I did that math. That works out to about 36,600 customers for the quarter. And so that's how I've figured out how many customers they might be growing into. Premium per customer, what that might be is a little bit trickier to say. I have it growing at about 3.2% to 374, and part of that more significant growth, like the last few quarters have been less. I'm suggesting, hey, there's probably going to be less new renters that are coming in the door, but there's more customers that are are bundling products or upgrading products, or the customers or Lemonade selling car to now at a price that Lemonade is happy with in the quarter, or they're renewing at the higher rate. So I'm expecting to naturally have a bit more of an increase. And if you look back every quarter except from 2020 onwards, except for the Metro Mile acquisition quarter, excluding that, they've been growing at an average of about 4%. You look in the bottom right corner, about 4% average growth, quarterly growth. So it's not outrageous to say, hey, maybe this quarter they're going to do 3.2%. That gets us to that $755 million in IFP, which I was talking about. They might hit something like that just naturally, even without any sort of customer growth on top of that. So I think it's crazy because this could be a very, very strong beat on their guidance, something in the 750 million IFP range for Q4 versus what they're guiding for, 729 at the high point, a very large beat. But it seems reasonable that something like that might occur, at least to me. And if we look out over those next 6 quarters into the first quarter of 2025, and you think about that 37 million per quarter is simply being added from rate increases, the baseline, it would be something like this, 755 Q4, 792 by Q1, then 829, 866, 903, and then 940. So 903 by the end of 2024, and then 940 by Q1 of 2025. This is sort of like baseline what Lemonade's suggesting could be coming just from rate increases, let alone more aggressive ad spend or growth initiatives by Lemonade themselves that could even bounce on top of that. So where I'm coming in is I have premium per customer growing at about 4% per quarter each quarter next year, and then slowing down a little bit after that as they get a little bit higher. Then I have customers growing at 3.5% every quarter except Q3. I'm growing at 5% because that's usually their bigger quarter. So if you look at that versus the baseline saying 900 million IFP by the end of next year, I have $1 billion in IFP, $1 billion and 28. IFP by the end of next year, and then 1.1 billion 2025 versus 940. I think these are reasonable, growth numbers for customer growth and premium per customer growth, especially when you contrast it to sort of on top of what this baseline could look like. And you might say, is this reasonable customer growth? If you just look at 2024 calendar year, then we have 331,000 customers joining. These are net additional customers. There's also customers that, of course, churn that Lemonade would also make up for, but these are sort of net additional customers that we're talking about. So 331,000 is what we're suggesting could happen in 2024. Again, all this is sort of to point back, hey, by 2026, can they even become profitable? So we have 331,000 there. 2025, we have 378,000 there. And for reference, if you're thinking about net customer growth, 2024, 2025, in 2019, they did 334,000, 2020, 357, 2021, 427,000, massive growth. 22, they did 380, that also included a Metro Mile acquisition that brought in a lot of customers. So If we're talking 330 and then 378 for the next couple of years, it's really within the realm of what's occurred in previous years. Of course, in 2023, they only did 213,000 customers, so obviously was lower growth, but in my opinion, as the rates come online, you'd expect them to accelerate growth a little bit more aggressively. And it's good to note, even in these previous years when they're putting up huge numbers of customer growth, they actually, 19, 20, 21, if you look back at the customer churn, was significantly higher. We can calculate it in 2020 was as high as 40% customer churn, then high 30s. So a ton of churn customers that they were overcoming and yet still growing at these ridiculous amounts. So in my opinion, what we have for 2024, 2025, into 2026, we have 331,000, 378,000, and then 2026, I have 429,000, is really, I think, realistic numbers of what they could do. And then I have premium per customer growing 4% quarter over quarter next year, a little bit slower the year after and a little bit less in Q3 because they're probably adding more renters those quarters, then a little bit less again in 2026 because they're also adding a little bit less there. And if we look all the way out to 2027, I have a similar amount of growth, but customers 476,000 and getting into that $600 of premium per customer range. And the reason I'm showing you even past 2026 is when they're expecting to be adjusted EBITDA profitable, but I'm showing you 2027 is nice because at Investor Day, they gave us this very nice graph as part of the Investor Day presentation, which was November of 2022. And at that day, they said, hey, by 2027, we're expecting to reach profitability here. And they said there's going to be $400 million of restricted cash. And during that presentation, they explained how they expect to move to a reinsurance structure that allows a 6-to-1 ratio in restricted cash to premiums they can underwrite. So the 6-to-1 ratio, they didn't tell us any of this Investor Day, but the details were here, really tells us, hey, they expect by 2027, they're probably going to be somewhere around that $2.4 billion in IFP range. If we go back to where I'm plotting this out, end of 2027, I have 2.3 billion in IFP. So very close, very much in line with what this graph was telling us. And that's why I'm even sort of showing you some of the details to say, hey, that anchor point for the end of 2027 or 2027 range, very much on track with what they were suggesting there. And so I think the next few years, what we're suggesting for IFP, the end of this year being $1 billion, end of 25, 1.3, and then 1.8, 2026, I think is reasonable numbers. By the way, if you want to support the channel and you want full access to this Lemonade model, you can play with it and adjust it yourselves. Feel free to join my Patreon. I really appreciate everyone who has already supported me there. Reinsurance I have in about the 50% range going forward indefinitely. And if you're thinking about gross loss ratio, let's talk about that now. They did 83% in last quarter. And then math on this gets pretty crazy because if you think about it, you say, okay, you have $718 million in IFP, right, that you're paying out 83% gross loss ratio on. But say over the next 6 quarters, you add $220 million in IFP, but you don't pay any additional losses on those rates. Say it's the same kind of customer base and the same sort of loss ratio effect, but you're adding all this additional premium just because the prices are increasing. It would result, if you do the math, it would result in a loss ratio improvement of going from 83% to 64%. Of course, they also might be adding customers along the way who are more risky or cohorts of customers that have to improve over time. So obviously can't expect this exact perfect number, but you can kind of see the direction that they're moving or should be moving in loss ratio over the next year and a half. And if you look at this slide from the Q3 letter, they showed a expected cohort lifetime loss ratio for different quarters over time. And then they said hey, this was from Investor Day in 2022, November, and they said, actually what happened, here's what the first year loss ratio for a cohort, so for a group of customers, saying, hey, we expected that the Q2 2022 customers in their first year were going to have 78% loss ratio, and those customers had exactly that. Now, then Q3 customers, maybe they're better at underwriting, their pricing is more in line with where it should be. They said, hey, we're going to actually have 71% loss ratio, but it was actually 68% loss ratio. So those numbers, somewhere in the high 60s to 70% loss ratio, moving towards that direction. I think that is realistic. That's what the numbers are telling us we should be moving towards. Of course, there could be catastrophic events in the meantime that could spike those numbers, could really mess things up temporarily. But I think that's sort of where the picture should be moving over the next year and a half. So that's what I've got for gross loss ratio, 79% this next quarter, which if you add in $37 million additional premium that we're kind of expecting for that quarter, you get that sort of a drop, about a 4% drop in loss ratio. And then slowly moving out over the next, until 2025, I have 72%. Still a little trying to be conservative, not going to just drop it into the 60-some percent, but being a little bit more conservative there, 72%. Then if you move all the way out again into 2026 range, I have it at 70%. So that's kind of, again, might even be a little bit better than that, but that's where I'm putting the numbers in for this analysis. Now, if we scroll down a little bit in my model to the operating cost side of things, and this whole block of lines here where we look at annual dollar retention, churn, and the sales and marketing cost, the way I've modeled it is I say, hey, if I'm going to input what I think the customer churn from 12 months prior would be, because that's, I think, fairly predictable and been on a steady decline. So I think that's sort of understandable, predictable. And then I'm going to say, hey, for every customer, including the ones that are net gain customers like we showed at the top, but also the customers that churned away and we had to replace those churned customers, what does it cost to get those customers, to acquire a customer? And that's helpful to know too, because we have the data from previous quarters. So we have pretty reliable data we can go off of into projecting into the future. And then I also have sales and marketing fixed, and I'm just projecting or estimating that continues to grow at about 1% a quarter into the future versus the CAC spend, sales and marketing variable spend, which is the customer acquisition cost, which is their direct ad spend that they're spending. So you put all those numbers, for these three orange lines is what I input, and then the rest are automatically calculated, including what the annual dollar retention would be. So their churn was just under 18% last quarter. I've just put in 18% indefinitely going out into the future. So 18%, meaning on a 12-month basis, 18% of customers would churn. And then customer acquisition costs, I'm saying in Q4, because of the Christmas effect and more competitive ad spend during those quarters, I have a little bit higher customer acquisition costs, which also matches up with previous quarters, previous years as well, where Q4 was abnormally higher. So Q3 was only $80 per customer. Now I'm jumping it up to $120 for this quarter. And then in the next few years, I have $90 in Q3 because, again, I think they can get customers who are cheaper there that are more of the renters type of customer. And then the other quarters, $115 is what I have, and then $125 at Christmas time. So I have that pattern repeating. Advantage that Lemonade also had is that because they have this base of customers, and a lot of customers maybe do churn over the years, but a lot of those customers do churn just because they're a renter, and then they moved and their situation changed, it's more transient, and then a couple years later they buy a house and they just say, hey, yep, I'll get Lemonade homeowners insurance because I love the product and I was delighted by it. So you have those kind of customer effects, those customers floating out there that are slowly coming back and would come back, and so should sort of have a positive effect within those numbers and how we look at their cost per customer gained. But anyways, you get down to a total sales and marketing of gross earned premium as a percentage of gross earned premium of 14% now, and then the trending down to 12% 2020 by the beginning of 2025, and even 10% in 2026. For synthetic agents, instead of just 50% or so of their CAC spend being done by synthetic agents like it was in Q3, I'm assuming they ramp that up to 80%, and they really make use of that over the next couple years through the end of 2025. So that's how I've inputted. I've done some estimates for what their total payment could be, their interest could be, and then I've assumed basically an extra 9 quarters afterwards. They're still making, when that ends, they're still making payments on that as that kind of trails down, as they pay off the amount of loan they had. Other insurance I have going for about 9% of GEP, trending down to 7%, even at 6% by the end of 2026. Tech development I have just sitting flat because management has kind of suggested they expect to spend very little. They expect to have a lot of operating leverage, so assuming the same amount of tech spend, just completely flat, especially over the next few years. 2026, I have a little bit of growth there, but going down to, as a fraction of GEP, down to 5% by the end there. G&A, same thing, super flat. I have going from 21% last quarter of GEP all the way down to 2026, only 7% of GEP, if they could hold that and then start to have a little bit of growth after that as they scale further and further. And if you look at all your total expenses as a percent of GEP, it's at 57% now, and part of that 57% was some Metro Mile one-time expenses that'll be gone. So you immediately have a jump down to 52%, and then that trending down to the end of 2026 down to 29% as they're becoming adjusted EBITDA profitable. Stock-based compensation I have at $15.5 million per quarter going out for the next few years. It's trickier to really approximate the cash flow, which they said should happen in 2025, positive cash flow. But based on all these numbers, if you look at adjusted EBITDA, I have it hitting the positive in 2026, which lines up very nicely with what they said in the Q3 letter. Is adjusted EBITDA profitability is expected to fall in 2026, a few quarters after cash flow turns positive. So to answer a question at the start of the video, it says, "Hey, is this realistic? Can Lemonade really do this? Can they reach profitability, at least on an adjusted EBITDA basis, by 2026? Is that realistic?" I think it's realistic. I think it's very realistic. I think the numbers we've input here, nothing is really crazy. Our 2027 number is actually short of what their Investor Day presentation kind of secretly suggested, that 2.4 billion mark. So on that growth path, we're looking at IFP growth of in the 30% range. They were growing like 70, 80, 90% in previous years before they really slowed down growth. They kind of guided something in like the 20-some% range, but have given little nuggets and hints along the way that, hey, we could definitely turn growth back on. And that's a big part of the whole Lemonade thesis, is that, hey, everything's built on this digital system, so we can aggressively grow, and we want to grow aggressively worldwide. So my thought is, hey, growing 30% IFP over the next few years seems really, really reasonable. My loss ratios that I put in, they're saying, hey, you're probably headed, the math shows, for the rate increases they're doing, they should be headed towards probably 70%, maybe even better gross loss ratio. And that's where I have 70%. So again, even arguably maybe slightly on the conservative side, if those numbers really are making sense. 70% there, you assume, hey, they have the synthetic agent agreement. They're probably going to make use of that, at least to some degree. If they don't need to, it's it's only going to mean they pay a little bit less interest overall to synthetic agents, but they use some of their cash sooner. So that might, however they decide to do that, we'll see that, and they might give some guidance on that in the Q4 results for the next year. But seems realistic. Sales and marketing spend, this is in line with what I'm suggesting they pay for a customer they're acquiring is right in line with what they've historically paid. Again, seems reasonable. The other expenses, you could maybe say tech's going to grow some, G&A is going to grow some, but it's not going to wildly affect the fact that they could achieve this. And it was one of my say questions. You go back a few quarters ago, or maybe even like a year ago, one of my say questions, earning questions that got answered was, hey, how are you saving costs, or what are you expecting with operating costs? And they said, hey, we really expect we're at a point where we don't need to, we can scale from where we are, aggressively scale and have huge operating leverage. So maybe there's a bit of more expense growth here. Maybe even they cut back. It's hard to say, but I don't think it's unreasonable. So you do put all that in, and hey, you're hitting profitability in 2026, just like they said. Lemonade Management has a history of guiding for things and then those things happening or even beating the guidance. So to answer the question at the start of the video, yes, I think this is very reasonable. I think there's a very good chance they become adjusted EBITDA profitable 2026. And you might be wondering, like, okay, why does this even matter? Like, what's the big deal? Who cares whether they really, great, they became profitable, big deal. Tons of insurers are profitable. Well, the company's valued something like, $1 billion market cap right now. And the reason this matters is that, hey, say they become profitable in 2026 and start printing profits. It's a big deal. It's a huge deal because they have the ability to grow and grow aggressively and grow fast and potentially be, a leading underwriter, risk assessor in the insurance marketplace. And they could make a ton of money. And so, I have adjusted EBITDA really skyrocketing as they continue to grow, as their IFP continues to grow. And this would mean, the potential for the share price, in my mind, it's in the teens right now, say $16, $17 a share. But it could go in the early 2030s to $1,000 a share, even higher than that. That's based on them making something like $300 million a quarter in net income, having a 69 PE ratio, which maybe is really high, but I still have them growing 33% year over year in IFP. So if you're still growing 30% per year, is that unrealistic? Maybe. I don't really think it is to have that high of potentially a P ratio, and then that gets you to a share price in the $1,000 range by 2034. Of course, it's really hard to project out more than even what we've shown in this video. I make a lot of assumptions just to do that, so take that with a grain of salt. But where we're going to is that I think there's huge potential for Lemonade stock. Could be a 50x, 100x, even more type of a stock. Just understanding whether this is realistic, what management is saying, and looking out the next 6 quarters, I hope is helpful for you. If you enjoyed this, you can support my Patreon, get full access to the model. Otherwise, you can find me on the Twitter at PaperBagInvest and follow me there. Thank you so much for watching. And remember, it's in the bag.